Hi, friends. Welcome to this new season of STOIC Talks. First, I would like to thank all you listeners. Even though STOIC podcast series, which started as a very small side project, passion project for me and Manish, and we only did very few episodes, the feedback which we got from all of you have been amazing. Now, all these years after we did our last episode somewhere in 2017, so many of you have asked us to resume this series as it offered a lot of practical insights into the investing world. The series became so popular that despite having a very few episodes, we were able to reach rank number 2 in the Apple podcast ranking, which was fascinating for us. Now, we thought of restarting many times, but we always had a lingering thought as to how, in this crowded world of podcasts and interviews, can we add value on a consistent basis. And after a lot of thought, we decided to relaunch this project. This time, we are also lucky to have a wonderful organization backing this project for us. So, with a lot of new ideas, some new formats which we plan to experiment with, a new co-host in form of Naresh, and hopefully a lot more practical learning for all you listeners and us too. We bring you the second season of what we now call STOIC Talks. So, hope you have a great learning experience. See you on the other side. Hi, friends. Welcome to the first episode of STOIC Talks Season 2. Today, we have with us Samit Vartak. He's the CIO and founder of SageOne Investment Advisor. Now, I have been following Samit's work for many years now. I've been a regular reader of his letters to investors, and he has carved out a good niche for himself in the mid cap and the small cap space with some really good top of the line returns. So, today, me and Nuresh will try to decode his investing style, his philosophy. We will delve deeper into his investing process and see how he comes up with those great small cap and mid cap names, and eventually how he puts them into his portfolio. With that, let's welcome Samit.
So, Samit, great to have you here on the podcast. What we'll be discussing today is everything about you, and we'll be poking you on all the things you've done over the last 10 years. And congratulations on your PMS completing 10 years. So, a good time to have a talk with you because you'll have a lot more learnings to share. And we would love it to be a candid conversation. So, don't be worried about whatever you want to talk. So, we'll start off with let us know something about you, as in how did you get into the markets in the first place? Because you've had a multiple areas of work before you got into the PMS side.
Yes. I think my path to the markets, is I think very different than most investors, because I was an engineer. So I grew up in a small village, 100 kilometers above or north of Mumbai. Right? And my father, we are from a farming background. Our generations, most of I was the first one to even graduate. So none of us had any idea about what the stock market is. So I did my engineering. Fortunately, I was able to come to Bombay. That was in 1986 or so for my or 1987 after my 10th standard, and I did my college and then engineering from Mumbai. And 1994, I think around that I graduated. And so I had no idea that I thought my father used to tell me about engineers and maybe some collector, doctors. So I had few careers in my mind. What I wanted to do, and I had taken civil engineering. So I thought, okay, it looks great because I can build buildings, some bridges, all of that. And that was based on. So I was, in a village. It was a very simple life. from morning to evening. Okay, other than that school part which we used to attend, it was mostly just play and fun, And our was a beach town, so we used to go to the beach, we used to climb trees and play all sorts of games because everyone had just time. So that was the fun part. And then when I came to Bombay, I mean, I took a while to adjust because I couldn't speak English. I was uh, sort of horrified when I had to converse with anyone. So initial part was very difficult, and I thought, everyone is so smart around me that how do I even survive in this kind of competition? Because everyone were doing classes, they were going for Agarwal classes, and yeah, so I mean, it took me a while. I mean, imagine that I was going for an engineering, and then until I completed my 11th, I had never even heard of something called an IIT. And then I saw, people were preparing for IIT and for years, and so that's how it was. It was completely just a random, career with no real thought. Something which I thought, okay, chalo, I'm good at maths, so let me go into, engineering is what the only thing. And then because civil engineering made sense, so chalo, I'll get into that. So that's how I got into. After that, from campus, I got job into Mahindra and Mahindra, and I did the job for 2 3 years, and then again I wasn't sure. I wasn't liking that engineering part that much, right? So one of the days, my one of the classmates, he was appearing for GMAT, and he was applying for few MBA colleges in US. So, and that time it used to be a very physical process of applying. You have to write a letter, and then the university will send you a form, and then you have to fill up the form. So it was like a long process. It used to take months, to even get those forms. And he applied to the top colleges, and he had a couple of forms left, which were reasonably ranked MBA schools, like 15, 20th, around that rank. And he came to my room hostel, and he said, why don't you also think about applying? I have a couple of extra forms. And that's how I said, oh, it makes sense, because I didn't know what I was going to do anyways, and what's the harm in at least applying. So then I quickly prepared for my GMAT. I gave my GMAT within a month, and then applied to these two colleges. One was that Washington University in St. Louis, and another one was Ohio State University. And fortunately, both of the places gave me admission, and one of the university gave me the scholarship to come. So that's how I went to the US in 1997. Just pure luck. And ironically, my friend never ended up going to the US. Who was like preparing for months or years. And that's how I went to the US. And then what happened was in 1997, that was that dot-com, boom. Like things were just hyped up, and then a lot of my classmates were basically doing investments in IPOs, on the side, and that's how I sort of got hooked up. There were a couple of IITs in our college, and they were really passionate about Wall Street, and they used to just talk about all kinds of traders, trading, Wall Street. And because I was hanging around with them, I got really fascinated with that. And I said, so at least let me take classes, of all investment related. So MBA, I almost whatever courses I could take on investment, I took. And then when I completed my MBA in 1999, I wasn't sure what I wanted to do. Anyways, 99, the wave was sort of turning around. Things were coming down, and from sort of a second tier, 15th, 16th ranked school, it wasn't that easy to get into top tier Wall Street firm. So I took the first job, which was with PwC Consulting, because of my engineering. I took that job, and fortunately for me, that gave me an opportunity to work with a lot of managements, because my role was to basically work with the mostly manufacturing managements, and look at their activities, what were the sort of redundancies, inefficiencies in the operations, and recommend which are the best ways to cut cost and reduce those inefficiencies and improve profitability. And then through that, thinking about growth. And I worked with so many these different managements in different industries, from dairy farm to auto ancillaries to auto companies to even logistical companies, because of that e-commerce which was developing in that. So that was a really good experience, because I could see from inside how managements thought, how companies work at the ground level. And then in the meantime, I started investing in 1999 in the market. And 99 was like the worst time probably to come into the market, because everything was just downhill. And I got my signing bonus, so I said, okay, now I should start. So I started, and because the markets were coming down, then of course you would lose money. And with the kind of knowledge that I gained in MBA, it was completely inadequate. So I started investing, lost initial phase was probably pure luck that I did well, but then things started just going downhill. And with losses, then you try to recover that with more, and US gives you so much margin, money on the margin, that you can leverage many times. So, and that's sort of a trap, that it's just a trap to destroy your money much faster. So that's what happened. And then that had a big impact on me, because that whatever money I lost was, I mean, that was massive money for for my family back home. And I stopped investing for a couple of years after that. I enrolled myself for the CFA program. I did the CFA, and then started reading a lot about different, all kinds of investing styles. Some from Warren Buffett to technicals to quant based, and all kinds of. And I thought, because I had no idea what is right thing. And as a sort of initial investor, I think it's great to try different styles. And then I sort of restarted with little more knowledge, and with the CFA, I restarted investing in 2003, 2004. And then I decided, okay, this is what I really want to do full time. And then my next step was that let me get more towards finance. So then I moved to the Silicon Valley with Deloitte Financial Advisory, and that was basically doing valuations for many companies out there. So that was a little more relevant. But actually, whatever knowledge I gained was really useful, because investments is all about understanding businesses and understanding valuation. And then when I went to the US, there itself I had said that I'm, with some experience, I'll come back to India. So in 2006, we came back to India, and since then mostly got completely. I came in as an associate director with Ernst & Young valuation practice in Mumbai, and then at the first opportunity I jumped into private equity, because at that time again that was a boom time and private equity was doing great. So I joined. I took probably 70% pay cut, because that was my first real investment related job. So I took that pay cut and joined, and that was the real start of a full-time sort of investment. Until then it was just as a hobby on the part-time side. But then when that 2008 sort of crash started, I was much prepared for that, compared to the first crash when I was wiped out, right? So that's when slowly I had realized that it's all about businesses. And I spent from that 2006 to 2012 meeting probably 400 companies during that time, and that was my passion, meeting companies, understanding the businesses, putting myself in their shoes in terms of how do you strategically plan your growth forward. I tried to understand as much as possible. My reading also tilted more towards like whatever helped me understand businesses, business models, and why some companies doing this versus the competition doing that. So for me, that became of much more interest. And then 2012 is when I started SageOne, and the journey started. But that's a little bit longer, but that was how I sort of got into investments.
No, Samit, thanks a lot for that. I think the initial part of the years of an individual decides what kind of investor he's going to be. and that's where the context which you have provided is actually very important for the next few questions which are going to be on the investment side of things. But just to get the chronology a bit correct, so when you started investing the first time, that was in 1999, you did levered investing. Did that I get that correct?
Initially, I started with just a pure investment, and the first few months were great because the markets were just booming. But after sort of the peak in 2000, when it started going down, that's when once you start losing money, you try to sort of recover because a stock. I used to invest in companies like Siebel or I2 and a lot of those Sienna and and Jupiter, and those corrected like 30-40% in a matter of few months. They were, and then you realize, oh, it's so cheap. So you want to make up the money very quickly, and then you lever up, and you want to buy more, and that's where I started levering or use the margin, the margin that the exchanges, brokerages give you there.
Okay. And one more thing which you said, which I captured, was that in 2008, you said you were much better prepared for the investment world than you were in 1999. Can you go a bit more into detail about what you mean by that? When you say you were more prepared, are you talking more from capital perspective, or were you waiting for the markets to do something? What do you mean by preparation in that sense of the word?
See, I think few things I learned was that it's all about. Uh, so there are few mistakes that like a starting investor makes, right? So one is, of course, you believe too much in what other people are saying. So if there is a company and there are, say, 20 analysts who are covering that company, and all 20 are saying buy, you tend to believe that that's the best buy that I'm going to do, right? So that was like my first learning, is that if everyone is saying buy and if everyone is already invested, that means generally it's not a great buy. So that was a mistake I used to make. I used to see which companies had the most buys, and I used to make that. Secondly, as the markets start falling, your instinct is to start buying because you think it's available 30%, 40% cheap. So that falling knife is something which I realized. Just because the price has fallen by 30-40% doesn't mean it's a cheap value. You, after all, have to evaluate the business much better. So in 2008, when actually the crisis started in January 2008, and then Bank of America, and then Merrill Lynch and Lehman Brothers, all of that started. And at that time, I thought that this is not something which is going to end very quickly. So even if the prices were down 20, 30, 40%, I never jumped in to buy. I held on to whatever cash I had, and of course, fortune also, sort of luck was also a factor, because when I came to India, I set a little bit into cash because I wasn't aware of a lot of companies in India. Because I never tracked the Indian market well. So I took my time to deploy. And when things started, going down, fortunately, I had 30-40% cash. And like previously, I didn't, start catching the falling knives. So that was the big difference. And then I started understanding the businesses and understanding the environment, how the financial crisis will have impact on each of the companies, which are the companies who will probably be able to survive. So I was much more rational rather than listening to others to take my decisions.
Interesting. So 2008, you did not liver up. Uh, Post that, how did you end up in 2012 into from you've been from business to valuations to private equity? How did you get into Sage One? And you can tell us the start and how did this happen?
Yeah, see, I mean, my passion was always to do something on my own, because I had done the, job for many years, and with job, after all, you're not free to do what you want to do. You are guided by the company processes, maybe the company philosophy, style, all of that. And since I had never worked on the sell side or buy side before, I had like no baggage of any style. I said, whatever it was all experiments on my own money and on me, and over the years, I had sort of fine-tuned what really works for me with, reducing volatility, with not too many big drawdowns, and by betting on companies. So I never ever tried to benchmark myself against indexes, because an independent investor, I thought for me, as a small investor, I have to compound my money. It's not just beating the benchmark, but I have to compound so I always targeted every 3 to 4 years, I need to sort of double my wealth. So that was something that I targeted for myself. And then I started thinking, is it something that I can replicate for the clients? And fortunately, during that time from 2000 and especially after 2009, I started focusing completely on the listed market. And then because I was on the private equity side, I used to meet a lot of, promoters. And then a couple of them, we used to discuss investments. And then I started informally advising them, about what kind of stocks to invest in. And a couple of stocks at that time, I remember I used to be very, very, gung ho about Bajaj Finance and Kaveri Seed. Those were sort of my top, conviction ideas at that time. So I used to tell them, like this is what is happening in the company. You need to invest. And so they invested, whatever tiny money that they invested. And that 2009 to 2012 was a great period. So 9 to 11 was anyways great period, but 12 was a bad period but because I was invested in these companies, I was invested in Bajaj Finance, Kaveri Seed, PI Industries, those kind of companies, they kept on doing pretty well. And because of that experience, I got much more confidence that even in a not so good cycle, if I pick the right companies, I can, do pretty well. And by that time, I had also gotten enough comfort that, because of corporate governance issues in India, and then private equity gave me that opportunity to sort of, do due diligences on companies. So I got much in-depth knowledge about, what managements do, how do they sort of fudge the, P&L balance sheet. I worked with auditors also because they also were part of the due diligence. So that gave me a first-hand experience of, what are the things which can, go or which can be sort of tweaked. And 2012, again, for me, I had no other than those couple of promoters who joined me with like 1 crore each. I didn't have my own capital, neither did I have a network of sort of clients. But I thought this is what I want to do. This is my passion. My style I had developed on my own, and I thought it worked pretty well. And I never tried to even get a job on the listed side anywhere in the, so I said, even if I don't make money, I had, this is my passion, and I'm right away, going to jump into it.
Samit, before we go to the investment side of things and go more detail into your philosophy of investments, I wanted to a bit dwell on a couple of decisions which you have mentioned in your life, even though it was passing mention, but they are very difficult decisions, right? So the first decision which seems to be the game changer for you is your decision to move from, from being the associated director with E&Y to the private equity by taking a 70% cut. Not an easy decision. I've been there. I know it's not an easy decision by any stretch of imagination. And many people, they get inspired from these kind of stories, but they don't get the underlying environment or ecosystem that helped you take that decision. I want to go a bit more into that because I have heard stories where people want to take those decisions, and when they tell me their circumstances, I tell them, boss, I would not have taken that decision if I were you, right? So ecosystem play a good role in these kind of. What were your circumstances at a personal level when you made that shift? Were you married? Did you have any family members dependent on you? Just give us a context of that decision, please.
Sure. No, you're right. I think it's one of the most difficult decisions, especially when you have a monthly check coming in, sort of saying no to that. So I was married with 2 kids, at that time, and I was the only one working. So the family was completely dependent on that. But even with that sort of 70% cut in pay, the money that I was making was good enough for me to at least survive. So when we came in, first thing we did was we bought a house. We had to take maybe like 50% kind of a loan on that house, but with the money, it was enough to pay that and survive reasonably well with a decent lifestyle. So that was something which definitely helped. But after sort of having worked for, almost 13 or 14 years by then, the salary that I was making was very, very uh, small compared to my kind of experience with, coming from US, having worked with, Big Four, and most comparable sort of experienced professionals were making 3x the money that I was making. But still it was enough. Our requirements were not much. We just bought a 2 bedroom a flat in Prabhadevi, and that too very old flat. We just renovated that, so it was also a very small investment that we did. So because of my sort of farming sort of background and the background through which I came in, my requirements were very, very small, and so I was able to take that decision much more comfortably.
So two quick decisions. So you went from US to India, then in India went to a 70% cut. Didn't people tell you, are you mad?
No, and fortunately, my family was always supportive, mainly my wife. So she knew how passionate I was about this, and this is what I wanted to do in my life. So I thought, if my passion is clear, and if of course you yourself have to believe that you are good at it and you will be able to sort of deliver on this. It's just matter of time before you make up the money. So I mean, it's always easy to say that follow your passion and the money will follow, but it takes, for me to make real money was so I took this jump in 2007, right? And I did not make much money until probably 2018-19. Okay. Until that, I was just, I started SageOne, but until that point, there's a lot of investment that you need to make and then at your level, you don't make much of, salary. So it took me a good 12 years to sort of really start, making money. And whatever money I was making only on the investment side, but my starting capital was very small. After coming back to India, having put up the equity and buying into the house, and so you don't really make, you know even if you make, say, 10x money on your capital, it's not going to be that big when your starting capital itself is so you need to first also earn money, right? And that earning money started way late, in 2018, sort of 18-19 kind of period. So yes, if you have the passion, follow your passion and the money will follow. But remember, it may follow after 10, 12 years.
Yeah, actually, that brings me to the second part of the question also in terms of the game-changing decisions. Uh, Going back, it sounds very obvious that okay, 2012 starting Sage One was a good decision, right? If you start your measurement from today, but as you rightly said, at that point in time, first of all, how was it possible for you? Because 2012, you said you had no capital. Your clients were only two clients, as you rightly said, right? 2 crores starting capital. How was it even possible for you to start? Because the initial net worth requirements are there to start a PMS. How did you go around, making that decision or coming up with a PMS and not going the normal route of, let's say, an advisory or a brokerage or something like that?
Right, right, right. No, initially I started with advisory. See, in 2012, there was actually no advisory license. You could just do advisory. Advisory license started in, I think they came out with the regulation in January 2013, and with some time for you to register, right? So I said, I can work from home. I don't really have much of fixed costs. I was just alone. I didn't have a team or anyone. So I said, I will do what exactly or I do for myself. So what I did was, for my clients, I didn't just advise them, but I made them open an account with, one of the brokers where even my account was, right? And then I took the POA to, do the execution on their basis. And then with my account, even their execution used to happen. So that's how I started, with really minimal cost at my end. And then once I got enough, bigger enough, then I went for the PMS and, went through the license. But initially when I started, I said, for me, it's more important that I keep my cost as low as possible, because I didn't have the, sort of the net worth required for the PMS kind of a license. So it took me a while to, even get that.
Okay, and just to get the chronology in place, when is it that you started your PMS, or you took the PMS license in the more official capacity?
Yeah, so I took the PMS license in 2016. That's when I took the PMS. 2016. Yes, yes, yes. So until then, so when the advisory license came, I took the investment advisory license at that time. And there were also issues with PMS license then. When we were speaking with lawyers at that time, what used to happen was in the PMS, you don't get a contract note. So because it's a pooled account, so the buying and selling happens at the PMS level and not at a client level. So there were taxation issues. So when Modi government came in, Arun Jaitley, clarified in the budget, regarding this, that you can, it will be up to the investor to classify as an investor or for a trade. So you can declare and then you stick with it. The officer cannot challenge you. And when that clarity came in, that's when I said, okay, it makes sense to apply for the PMS license. Until then, because PMS had a lot of issues with, investment, the IT guys coming after you, and that's where I applied in 2016.
Hi, friends. I hope you're enjoying this episode so far. I just want to take a minute to thank the sponsor for this episode. Now, STOIC Talks was built on a premise of actionable insights, and detailed questioning without constraints is the only way to get that. And for that, you need independence. Now, when you're looking for somebody to partner with, you're not looking for somebody just who share your ethos, but who also will promote this independence of asking fearless questions without any hesitations. So when we were looking for someone like that, the obvious choice for us was DSP Mutual Fund, as I have known their team. I have worked with their team for a long period of time. Now, if you're an investor, there's a high chance that you are already familiar with at least some, if not all, of the excellent research that they put in public domain. There are reports like Netra on the macro parameters. Then there is a report called the transcript, which gives important snippet from the Concord transcripts and discusses them. Then the annual report Nectar, the Navigator, and many such excellent reports, which I enjoy reading and is enjoyed by many practitioners in the investing community. So we are extremely happy to be working with such a team. They completely agree with our vision for STOIC Talks, and I wholeheartedly want to thank them for supporting this episode. If you aren't already, I would highly recommend you to follow them on Twitter with their Twitter ID as @DSPMF. And you can also follow them on their YouTube channel, where they put a lot of insightful videos regularly. Thanks, and enjoy listening to this show. You mentioned about styles when it comes to listed markets, which is not there in private equity. Let's talk about styles. Right now, you and in many of your interviews, you have talked about the business quality, and we'll come to the 4 pillars on which you have named your company also, Sage. But you also mentioned in the initial questions that you experimented with a lot of things, right? You experimented with quant, Warren Buffett, technicals, and many things. Just take us through the journey before you reached your current situation, or even in 2012 when you started Sage. I'm guessing that when you started Sage, you had a much more clarity on your style. But let us take you let you take us through the journey of that, reaching that style. How did you reach that style? What did you experiment? What did you lose? What did you learn? And so on and so forth.
Right. So see, after 2001 is when my real sort of education started. And then I started reading a lot of books, Warren Buffett, which spoke about the fundamentals and all of that, which made sense, but that also required you that you spend a lot of time, really going in depth into companies, and doing that as a sole investor with a full-time job in the US, which needs you to work, 12 to 16 hours a day. That wasn't practical enough for me. So during that time, I also came across this CanSlim style. I think Bill O'Neill. There is a newspaper, investor's business daily, which does a lot of fundamental ranking for you. So fundamental momentum, even within an industry, it does the ranking for you, and it does give you a score. So with that, at least I got some shortlist of companies to look deeper into. It weren't just in the US, but so that made a lot of sense to me, that having a combination of technical as well as fundamental and then momentum wise, where earnings, it's not just the price momentum but also the earnings momentum, and that too relative momentum against the industry, right? So at least that gave me a starting point to look into, because otherwise there are thousands of companies. Where do you really look into? So I started focusing on like the top 25, 30 companies, within which I looked at companies which made sense to me, which the industries I liked, and then where there was growth. So the focus was completely on fundamental momentum in earnings growth. And because maybe it's pure luck that the time was really good during that time, 2003 to 2007, everything was doing well. But because I did that, I got the confidence, okay, this works, so, and then again, so I continued doing that without really, I mean, I couldn't visit the company or talk to the management, just on a very passive level, just looked at, financial statements and how the earnings were coming through, and it worked pretty well for me. And so when I came back to India, that kind of data wasn't available for the Indian markets, and that's where I said, I wasn't sure what to invest in India, and hence I was, whatever money I had, I at least kept it in some in cash, right? And 2008, I had invested in a house in Andheri, that we sold. So I got few lakhs of profits. That was in early 2008, and that, like, if I was like my previous self in 1919, I would have like right away jumped into catching all these falling knives around me. But fortunately, I kept that cash for a long period of time, because I wanted to get comfortable in terms of understanding these businesses. But the bottom line for me was always earnings momentum. Where are where is the relative outperformance and all of that, and that private equity gave me that opportunity, at least, to go around and meet companies. And yeah, I mean, at least I had a framework of looking at the companies, and which took its own time. And after 2008-9, anyway, the markets had fallen so much that, I mean, I knew companies like Gujarat Fluoro, and they were available at 1 times EBITDA, kind of enterprise value. There's so many companies available at 2 times, 3 times, EV by EBITDA kind of levels. So then, if you have the money and you invest in any of those companies, you will do pretty much fine. Right? So again, that was also a lot of luck involved. That because of initial phase of experience, I sat on cash, and by the time markets had collapsed, I had enough cash to invest, and that did pretty well. And then as I got more and more exposure to sort of meeting companies, and then actually evaluating these companies, then ended up at least with the right framework, picking the right set of companies. All of these companies, whether it's the Bajaj Finance or Kaveri and PI, they were really cheap. Even in 2011, 2012, they never really got sort of re-rated. But the earnings momentum was so strong that even if you don't get re-rating, which just because of the earnings momentum, actually you could make a lot of money. So the time period in which sort of I really experienced, Indian corporate, was also very good for me in terms of starting your investments, and that worked out pretty well.
So in terms of, say, we are talking about Kaveri Seeds, I think you have an interesting story to say also. And now that you don't own the stock, you can talk about the company much more easily. How you got in, and I think you almost wrote a note also on the exit. So, and there was a lot of scuttlebutt involved in terms of actually accepting the numbers, I suppose.
Right. So see, I mean, Kaveri seed, and at that time that was the initial phase. So you're always excited to, and being a farmer, I also connected well with that company. So not just me, but a lot of other investors were, like Manish also used to go. Even I think Girish Gulati, the Delhi investor, he also was doing scuttlebutt on Kaveri. So, we could always connect together to share what everyone was, finding. So during just pre-monsoon, that was the peak time, for looking at which seeds were selling the most. And there were two big markets. One was Andhra Pradesh and one was Maharashtra. So at least if you could go to that cotton belt and then talk to the farmers and also talk to the retailer who was selling the cotton seed packets, you could see, which company was selling the most. There were two big ones. Noziwood was the biggest one, which had almost 20% market, and Kaveri seed only had 5% market. And based on our scuttlebutt, we realized that there was not much of a difference between sort of Nuzivudu quality of seeds and Kaveri. Actually, Kaveri, the farmers used to give feedback that there are a couple of those seeds were really good. And hence we thought that there is no reason why Kaveri should not sort of reach, that 15-20% kind of a market share. So there itself, just because of market share gain, they should probably at least triple from here, top line. And hence we took that call. But after all, see, as a long-term quality investor, one has to realize that after all, Kaveri is a regulated, can always be regulated, because whenever it comes to farming and pricing and government, things can change in a matter of a day. And that's what actually happened. That the seeds were under such a short supply that many a times it used to sell in black market. So the price of the packet officially was like 900 rupees a packet, but there were times when it was selling at 1200, 1600 rupees in the black market, unofficially. So I think because of that, Maharashtra government came in and then they set up a peak, sort of a slab that you can't sell this above 800 rupees. And then the government is going to control the pricing. And with that, you realize that the business model is completely failed. And hence, as soon as the business model fails, you got to realize that your hypothesis now, has completely changed. You got to change with the changes in circumstances. So fortunately for me, I completely exited out of Kaveri seed. And at that time, I was managing money, in SageOne. So for clients, I completely exited. And then the group with which I was, connected, they said that, that's okay, it's a minor change. And really, we are completely fine holding on, because the P multiple was still low for these companies. It was always like 13, 14 P multiple. So many of those investors, kept on holding it, and I fortunately got out. And I think the price then was 800, and then slowly it came down to like 400. And even today, the price is, after probably 8 years, it's still at 500-600.
And in Kaveri, I remember people had a issue in terms of no tax because of being agriculture income. So I think you can tell us more about how did you accept that this is all the numbers are true.
Right. No, I mean, see, I think one of the checks that we did at that time was that Monsanto, the technology was from Monsanto, so they had to pay royalty to Monsanto, right? So question is, if they are selling number of packets, equivalent amount of royalty has to go to Monsanto. And fortunately, we had some connections in Monsanto where we could cross-check that there was that much royalty paid, and that gave us that comfort that, okay, the sales are real, and speaking to farmers, we got a first-hand report on the quality of seed, and that was good enough, that at least the sales are not fake, they are not just on paper, because that is very easy when you're not paying tax, who is going to question, right? It's very easy to fake sales, but with that Monsanto in between, we got that comfort, and we are fine investing.
Samit, let's give a structure to your investments, and how do you how do you go about selection, allocation, and all key components of investment style. From what I figured out about reading your memos and from your website and many communication which you have done in various media houses, your selection is reflected in the name which you have, right? So when you say Sage, you're talking about sustainable, accountable, growth-oriented, efficient businesses. So this pretty much zeroes down what kind of companies you're looking at. Is that a fair assessment, or you do deviate from it? You know, sometimes you start with a name, but then investment philosophies evolve over a period of time. Okay.
That's completely fair. We look for definitely things which are, sustainable, structural in nature, and growth is definitely, our primary focus. Valuation is something that is important, but that's never a starting point. So that's completely what we, look for and we stick with.
So then why let's not, let's expand it a bit. When you say sustainable, what exactly are you evaluating? What all things you're looking at in the business when you're looking at sustainability? Similarly, when it comes to accountability, what all parameters which helps you evaluate this? So let's start one on one, one by one. Can you take us through what do you mean by sustainable and what exactly are you looking for?
Yeah, so sustainable. So for example, we don't invest in commodity companies, right? Commodity meaning that companies which may be selling commodity products, but the business model is not commoditized, right? So I'm invested in APL Apollo, which you may call that it sells commodity, but the business model is not commodity because it has the pricing power or pass through power. That if even if the steel price is at 30 or 60, generally they end up making the EBITDA per ton. So that EBITDA per ton is sustainable, so then we are fine with that. Whereas if you look at, say, Tata Steel, their cost structure is almost fixed. It doesn't change with the change in, steel prices, right? And the selling price has nothing to do with the cost structure because the selling price is driven by the global factors, right? Tata Steel cannot set up a price for, and hence their profitability is not sustainable at all. It can be hugely profitable, it can go into losses. And so that's a commodity kind of a business. So we stay away from such businesses, right? So when we exited Kaveri Seed, I mean, that was a big issue that now the margins are not sustainable because the cost structure is not something which is in the control of Kaveri, but the selling price is set by the government, right? So now the margins are not sustainable because who knows whether the government will drop that price from 800 rupees a packet to 700, right? So the company should have that freedom so that their margins and profitability is sustainable, and that is what we look for in businesses.
Does that also take out certain industries or companies that goes through certain tailwinds which do last, let's say, one cycle or 4 or 5 years kind of cycles, because not all businesses are structural from throughout the journey of 20 years. Some, they go through periods of sustainability and then they go through struggles and then the cycle turns, etc. So does that sustainability angle take out those 4 or 5 year cycles also, or do you evaluate them in a different way?
No, see, as a investor, you can't have a 10-year kind of a view, right? So I think there is a different sort of period in terms of two aspects of investment. One is you have to evaluate in terms of growth. What is your growth horizon, right? So as I said, we look for companies where the earnings will double in 3 to 4 years, because if you're looking for portfolio double in 3 to 4 years, earnings has to double in 3 to 4 years, right? So whether the sustainability is pretty much guaranteed or sustainable during that time, the EBITDA margins, the profitability is what we look for. But when you're evaluating risk, risk has to be evaluated from a much longer term perspective, because that disruption or risk can come in at any point in time. You cannot time it. So with that sort of growth of 3 to 4 years, you got to see what is the worst case scenario possible in terms of risk and whether that risk can come in. So if disruption is one of the risks, say in combustion engine, at that time, if you think that the risk can come in the next 3 years or 4 years, even if you think that the margins are sustainable, you stay away from such companies, right? So generally you look for your investment horizon, and it's a sort of a rolling ball. You at every point in time you keep on evaluating in the next 3 to 4 years, what is first of all the sustainability of profitability, sustainability of growth, and then what is the possibility of that big risk hitting you and sort of disrupting that business. So sustainability can, at least in terms of margins and growth, need to be there for your investment horizon. For me, it's not 10 years. It's generally 2, 3, 4 years. That is the investment horizon, and you keep on moving that forward as you go along. And whenever you think, okay, now the possibility of this is very, it's going to happen in your investment horizon, you get out of that business.
Let me, pick up few things which you said in that explanation. You said you're looking for 3 to 4 years doubling of earnings in your businesses which you're investing into, because that's your ultimate investment goal also for the investments you're making. I'm guessing re-rating is an optionality you are counting on, but that's not the underlying principle of your investment. Can you then, give your point about the valuation? It's very clear that you are not focusing way too much on valuation, but more on the growth part of the business. Where do you draw the line? Can you give your views on the valuation front also?
Sure. See, at least in my experience, right, whenever, if I look at all the multi-baggers that I've invested in, right from, say, Kaveri, Bajaj Finance, Aarti Industries, PI Industries, Lao Pala, like APL Apollo, Deepak Nitrite, PKT, all those, the starting point was very cheap, right? So, unfortunately, the starting point and the P multiple is not always in your hand as a fund manager, because as a fund manager, you get money every day, right? So the only sustainable way of generating that, if I double in 4 years, it's 18% return. If I double in 3 years, it's 26% return. So 18 to 26% range of returns is only possible if the earnings growth is at least that much. The valuation re-rating is a lot of luck involved based on your starting point, right? But my experience has been, if you want a real multi-bagger, which is going to go up like 5x, 10x in the next 3 or 4 years, it will not happen if the valuation is not really cheap. So that is going to happen. It may not happen. You will not find such companies every time. You will have only maybe in a 10-year phase, you will have 2 or 3 such times when you are able to find those companies at such valuation. So one time was, say, in 2012-13. The next phase came in probably in 2018-19 or during COVID times. So in the last 10 years, I would say there were only 2 real such phases where you could find such valuation multiples. Otherwise, 2014 to 2000 or mid 2018 were all high valuation. Those starting points will very rarely deliver you these huge multi-baggers. Similar is the time today. With such valuations today, okay, you can make consistent returns. That 18-26% is possible. But if you are looking for large multi-baggers, it will only happen through valuation re-rating. I mean, imagine that in Bajaj Finance, the starting starting price to book was 1 to 1.5 times, right? And that over the next 5-6 years went up to 9 times. So there was huge re-rating. PI Industries, the starting multiple was 15 times. Today it trades at 45 to 60 times. So generally I've seen that in a huge multi-bagger, multi-bagger which is about 10x in a 4-5 year kind of a period, the 2 to 3x returns is only because of P multiple re-rating, and the remaining 2 to 3 times multiple will be because of the earnings growing at that kind of a rate, right? So but as a fund manager, you don't have that kind of flexibility of just keeping on waiting for such times.
Let me invert that again. So as you rightly said, as a fund manager, you don't have the choice of when the capital is coming to you. I understand this side of the thing, that okay, valuation might not be in your favor all the times for a re-rating to play, and hence the focus on the growth aspect of it. But then there is the reverse side, that when there are valuations which are completely anti return possibility, whether there's a de-rating possibility much higher, forget about re-rating. So how do you deal with those kind of phases? Because growth is something which is not something you can compensate for in saying, "Acha, ye de-rating ho gaya, so I will have growth supporting me." So how do you deal with that phase of market?
Yeah. As you go along and you experience, I mean, that's a real threat. You may not think because, see, whatever you may sort of propagate that, I have a 10-year horizon. Investor may also think that I'm a very long-term investor. But what happens is that when there is a derating, it is so sharp. Like, whether you look at 2008-9 period or even 2013 period or COVID times, the P multiple dropped by almost, 40-50%, right? So normal 25 multiple became a 15 multiple, right? And now going back from 15 to 25 is almost 60-70% return, right? So unless your earnings growth is 60-70% during that phase, you will end up losing money. So even we have had period, say in 2017 peak, our portfolio's P multiple was at 30 to 33 times. And at the bottom of March 2020, during COVID times, the P multiple was at 15 times. So it was almost half of what? And during that time, even if my earnings doubled in that 2.5 years, my portfolio returns will be zero, right? So there will be long, like when you look at last 10 years, there were periods of almost 3.5 years when we made no money, right? So I mean, we had taken a conscious call in 2017 that we will not accept further money. So for a year we had stopped taking any money. Even last year in the small cap fund we said we will not take any money. I mean, that's the only thing you can do, and you warn your investors that this is the situation, right? See, what happens is that investors also have asset allocation. Many of the, especially the ones that come to us, these are large families, they give us 2, 3, 4, 5% of their net worth. It's not their entire wealth. Most of the investors do not give us the entire wealth. Mostly it's in single digits, right? And it's a part of their asset allocation. So in terms of valuation, they need to play around with the asset allocation. How much to invest in, alternative assets, fixed income, equity. And within equity also they may think, where to sort of concentrate, which fund manager take it out and which fund manager to put in. Right? So those kind of things are done by them. So at our end, we can say that, okay, this is not the right time to come in. Don't give us any more money. Or if there are new investors who are coming in for the first time, we'll just not take them. So I haven't really found a solution beyond that. Because see, as a fund manager, I may think valuation is high, but what if it continues for the next 3 years or 4 years, right? You will never know. That's just a highly probable event that the returns from here on are going to be very, very difficult. But not necessarily is this something which is going to play out, right? So even I need to keep that possibility as as an outcome, right? And accordingly, I can't just go like on my limb and say, okay, this is the time, just get out of everything, because I never know. Like, what if after 2017 India got into a really boom phase for the next 10 years? Then I would have fallen on my face.
Going into that part, because we've seen all your memos and I've been reading for a long time, is that the quantitative part which you put in, wherein you do a lot of market analysis of all the stocks, the earnings of all the stocks? I've seen you compare the top 400 companies, the bottom 400 companies, earnings growth. This is what helps you see, because you've done superbly well in your small cap, but your timing was just prescient in terms of the time when you came out in, because you launched in 2019 and not in 2018, right? And I think there was a memo in the start of 2018 also, and your take on long-term capital gains affecting the valuations, which you did. So could you tell us more about how this whole quantitative side of it helps you decide not just investments, but this sort of asset allocation call or taking a call? Because you were buying into small caps, but you launched a small cap fund only in 2019.
Right. Yeah, I mean, see, what happened was, as you become big, liquidity is such a big issue that you end up migrating more and more towards sort of mid caps and large caps. And then you have such a large universe. I mean, it's like 80% of your companies are in that, bottom sort of 10% of the valuation, right? That's small cap, which is almost impractical for most fund managers who are managing anything above, say, 500 crores. So there is that, huge universe which is so inefficient, and as a fund which had grown to 700-800 crores, we had to let go of a lot of those opportunities. And then as Nooresh, you said that I keep on doing a lot of slice and dice of data, and some of that I do present in my memo. But there is a lot of other data which I keep on evaluating in terms of what is sort of completely out of favor kind of asset class, or within that equities, which sectors. And small cap at that time had presented the valuation gap, and as well as the FII, DIIs, because in addition to the long-term capital gains, there was also that SEBI reclassification of mutual fund, because of which fund managers had to forcefully exit. And I had seen myself that if ever I have to buy 1% of a company within a matter of say few days, the impact cost was at least 15 to 20%. So that's how illiquid Indian markets are even now. I mean, if I have to buy 1% of a company in a matter of 3-4 days, the impact cost can be sometimes as high as 30% or 40%. Right? So you can imagine that if you're forced to exit out of these mutual funds from so many of these companies, it is natural that those stocks, and while selling, the impact cost sometimes is even higher because there is no one in front to buy. Right? And hence I thought that was a factor in almost all the small cap companies, because all the mutual funds had to forcefully get out. And I thought that was one of the best times to come into the market. Hence we said, this is the time to come into the market. During my launch call, I had told that I had never told my in-laws to invest into the stock market, because stock market is so uncertain and they were never experienced. I even told them in 2019 that whatever excess money you have, just invest in this. So that was the first time ever they invested into the stock market. But even when we launched, I mean, there was not much of a response from the investors, because the times were so bad that it took a lot of guts to come into the small cap space then. It was like so beaten down, and but that's the time you got to come into the market, and hopefully that is what we will keep on doing. That when we launch a certain thing, it is so out of favor that for most investors, at least the experience will be good. And with consistently doing that, they will at least realize, okay, whenever we come out with something, it is better than average time to come into that sort of class.
STOIC Talks has been partnered by DSP Mutual Fund, which was an obvious choice for us, having interacted with the DSP team earlier and recognizing how they are obsessed with helping investors take better decisions. Some examples of their motivation to help investors do better are visible in their research-related work, which they make available for free, including Getting Smarter, Tathya, Report Card, their Invest for Good blog, among others, and many more reports. We thank Team DSP for supporting this episode of STOIC Talks and recommend that you follow them on Twitter. Their handle is @DSPMF.
Samit, so we are going into now the portfolio side of things. Before that, I want to finish what we started on the selection part. We did cover sustainability, we did cover growth oriented. Can you also comment on what you mean by accountable and efficient, and how do you measure those parameters when it comes to the companies you're buying?
Right. See, accountable is more of the management quality. It's whatever they say, whatever they have committed, they deliver on that. Right. So that is what we look for. It's all about the management quality, accountability of the management in terms of execution. And efficiency is more about capital allocation, because it's all about when you're looking for growth kind of companies, which we look for, you have to be very, very efficient in terms of capital allocation, because the reinvestment is continuous. When you are growing at 18 to 26%, most companies' ROE is going to be in that 20-25% range. So almost all of the capital you need to reinvest into the business, to keep on growing at that rate. So you need to be very, very inefficient. So it's all about, and then that is one of the biggest factor we try to evaluate, that the future investments that they do, the incremental return on investment has to be higher than their existing return on investment, because you don't need to go down the value curve just for growth's sake. You don't want to invest in poor quality sort of opportunities. So that's very important, and that's the only way you can, without having to leverage, you will be able to keep on sustaining your growth rate. Because if you leverage, it actually doesn't remain sustainable. At certain point, you'll have to, completely stop.
That actually brings me to two questions when it comes to capital allocation. So one, correct me if I'm wrong, but my assessment then becomes that the first criteria is going to be past good asset allocation when you are selecting a company. So you're not going to go into the stories of where the turnarounds will happen or where the efficiency will come in, but the management has no record whatsoever of doing it in past. So I'm guessing that you will let go of those kind of opportunities. So hence, looking at past capital allocation is an important criteria for you, which you can judge using return ratios or something. Is that a fair understanding? Okay. There is no other proof, right? And secondly, so then the question becomes more of incremental capital and the scalability, whether it is there or not for them to deploy that capital, but you're not going to make an assessment call on new capital making more returns than what they have done in past. That is the first assessment.
Right. That shows that the capital allocation decisions are good. Otherwise, I mean, there are always opportunities. If you want to just make 12, 13% return on investment, there are millions of opportunities. But you need to focus on the ones where at least it will have 20% plus.
The second thing which you said is that just when the capital allocation is not there, you don't want to go down the curve to chase growth, down the quality curve, so to speak. Do you make those kind of decisions at the valuation side also? So I wanted to, when we were discussing valuation, I wanted to ask you this, that you said valuations are crucial for the next few years of returns, especially when they are on the higher side, because there is a possibility of derating. In the scenario when you find your companies to be in that zone, do you make a shift out of those companies primarily because now they have gone into the zone where it's pretty much given that derating isn't going to be the future rather than re-rating? Do you make those decisions?
Yes, yes. So on your first question of not going down the curve for valuation, I mean, see, there is just because there is growth doesn't mean your valuation will increase, right? If investor expect their return on equity from the company or return on investment from the company, say at a 18% level, and the company invests in opportunities where the return on investment is going to be 12%, actually you're destroying value. Your P multiple as well as your total market value actually will come down, So that is something which is very, very important, that they need to invest where their P multiple as well as market valuation should, go up. In terms of derating, see, after all, it's all about making returns, right? So for example, if I have a company which is trading at a P multiple of 10 times, which I think, for that kind of quality of company, its multiple seems really low, right? And say 3 years down the line, its earnings say goes up by 20%, right? And the P multiple say also goes up by 20%, right? So overall, maybe you'll make 40% return during those 3 years, right? Whereas you have another company where the P multiple is say at 40 times, where that okay, it is maybe above its sort of fair valuation, but in the next 3 years, it is say going to double its earnings, right? So even if the P multiple say comes down from 40 times maybe by 10-15%, my returns from 100% will come down maybe to 80% or 85%, right? So still I'm going to make more money. So that's the call you need to make, that what is your starting multiple, what is the ending multiple, in between what is going to happen to the earnings. So sometimes a derating also is reasonable enough for you to invest.
But let's take that same example which you did slightly further and say that okay, the P multiple now is in an uncomfortable zone, right? It's not 40, let's say it's 80. At that point in time, so my question here is more towards, do you make exit calls or even allocation adjustments based on valuations if the valuation goes really, really berserk?
Yes, yes. See, because I've done professional valuation, I think one thing is very clear to me, that fair value is not one number. Fair valuation is a pretty large range. So a fair valuation can be from 20 times multiple to even 40 times multiple. But beyond 40 times, 45, 50 times, that it's an extraordinarily expensive valuation. Below 20 times, it's really, really cheap. right? So whenever the valuation is beyond, say, extraordinary, those times, if we are invested, we'll get out. If we are not invested, we'll not invest. So, but we are pretty flexible in terms of that fair value range. So there I'm okay, because I don't know whether it's 20 times the right multiple for it or 40 times is the right multiple. But at 45 times I know it is not the right multiple for it.
Okay, I'll just move into, so we are now moving more towards the allocation of the portfolio side also, but on the point which you just mentioned, let me ask you a follow-up question. So let's say you are in that zone where you take that exit decision, right? Because the valuation has gone into a very uncomfortable zone. By the very act of selling, you will have cash available to you, and cash brings in the the mental liability of redeployment, so to speak. Generally, those kind of market environments come when overall markets are also pretty overheated, and if you want to find value, or you have to go down the quality curve. So is there a decision of how much cash you want to be in? Let's say you are in a very overheated market. How do you manage this aspect of allocation?
Yeah. No, I think that's a very important aspect, because what happens is that whenever you have cash, a fund manager, natural tendencies, like there is too much urge to just deploy that somewhere, because you think that you may lose out on the opportunity. So there is a huge opportunity cost. But, see, as a long-term sort of investor, if you want to take the right decisions, for long-term returns, you have to set certain rules for exiting, and if at that point, if there is not better opportunity to enter, then better you stay out of the market. I mean, that's the only strategy which will make you have higher cash when there is complete froth in the market. So we are completely fine going even up to 35-40% cash if we are exiting, and if we don't find opportunities, we can wait and watch. So and I think it's very, very difficult to do that, but as a prudent strategy, I think for the investors, that will give them a lot of confidence. Especially markets have become the cycles have shrunk so short, the volatility has also increased, that these kind of corrections happen more often these days. So as a long-term fund manager, you don't have to think that you need to be completely invested all the 10 years, because I've gone through phases where there are periods when you make no money for a long period of time, 3-4 years, right? And at that time, the opportunities sometimes you get are so attractive that even if you have 15-20% cash, that cash can be as equivalent of having 40% cash, because the valuations that you get are probably at 50 or 60, 70% discount during that time. So that cash is hugely valuable.
Okay, but let me also bring in an argument which 100% cash people bring on table majority of the time. See, I like to go in cash myself, so this argument is not mine. But what I have heard often is that, see, history has taught us that the overvaluation zone goes to crazy overvaluation zones in the absolute euphoric market. So imagine yourself sitting in 2006 kind of an environment. Companies were overvalued, and then they became crazy valued, right? So when your yardstick to exit is based on valuation, you can take yourself out of the game and go in those 35%, 40% kind of cash much before the market peaks out, and that impacts your relative return tremendously. I mean, relative performance, so to speak. Are you saying that that decision will make back those 40 lost opportunities in the flip side on the cheap markets, or is that a decision which worries you, or how do you deal with this argument of 100% cash?
Right. See, I think a lot of the argument of 100% cash is by large fund managers, where they get a lot of institutional money, where there is a lot of yes, a lot of right. So 100% equity decisions, I think, is I mean, see, many fund managers just focus on the outperformance to the market, right? So they are completely, that's their sort of mandate that they need to outperform the market. So whether it's going up or down, it doesn't matter to them. The absolute returns are not important. It's the relative returns, which are important, because it's all about the asset allocation that their clients have done at their end. Right, so that is also fair. It also depends on the investor. What is its mandate? Is it absolute return in the long run, or is it a relative return in the long run? So for someone like us, or if you are focusing on absolute return, you are right. I think there could be periods where there is a huge bull market, like what happened in 2003 to 2008 period. But it happens, once in I don't know how many years. Not even in 10 years. Right? So, but because of that sort of experience, you keep on taking decisions based on that one event. Right? I don't know whether it's the right decision. It may not happen. Right? But if you are patient enough, after 2008, the market, the small cap, mid cap index went down by 74-75%. Right? So it probably gave up the last 2 or 3 years of gains. Because to go back to that level, you have to go back 4x now. So if you are patient enough, and if you are sitting on cash, even those huge bull runs actually rationally make sense. And in normal markets, I think these days, the corrections happen very often, and that 20-30% kind of a correction is so often these days, that I think, see, you don't have to go back into 35-40% cash at every point in time. Those are the situation when they are really super normally expensive. And here, even if it's 15% or 20% kind of a cash, you still are invested 80-85%. Right? But that 15-20% cash, when you get the opportunity sometimes to buy at 40-50% discount, it's extremely valuable. It makes up more than having just invested 100%, because in a down market, it's very difficult to exit, especially as for a small and mid cap fund manager. It is almost impossible to exit and create cash during a down cycle. It can only be done when times are good. So, and I think 15-20% cash is reasonable enough with not too much of an opportunity cost.
So when was the last time you took a big cash call in the PMS or personally?
PMS, so I mean, my personal and PMS is exactly replication. So last cash call that we had taken was during COVID times, and I had also written a note to my clients during that time why we had taken a cash call. But that was more of a macro cash call. That whenever there are too many unknowns, which was the case then. COVID was such an unknown event, and the implication of COVID were even more unknown. How the governments will react to it. And with that, what kind of impact it will have on the economy and corporate India. That was so much unknown that for me, it didn't make sense to be 100% invested at that time. So, and the time that you got to exit was like very short. I thought, okay, let's slowly take, cash call, and we got into like 15-17% cash. Our goal was to probably raise 20-25% cash during that time. But the next Monday it opened like 10% down. Now what do we do? You can't do. But still we were about 17-18% cash. And if it was a slow sort of down, then we would have been more in cash. But what we thought will happen over the next 3-4 months, happen in the next 2 weeks. After that 23rd, even India announced a full lockdown, and by that time markets were down 30%. And we said, now at least COVID risk, even if it's not known exactly, but a lot of it is priced into the market. And then the actions taken by the government is also pretty known. They're just going for a huge lockdown, and then they will shut it down for 2 or 3 weeks and then open it up. So we had gotten some sense of what it is going to evolve into, and then the markets were down 30-35%. So we thought that let's reinvest now, and within the next 10 days we had reinvested all the capital that we had.
Samit, we have discussed valuation-based selling. You sell when you find overvaluation in your companies. What are the other reasons when you get out of your positions, both from the business side, and I mean when you're making money or when you're losing money? So how do you evaluate those situations from the selling perspective?
for us, because we have a clear goal that we need to invest in companies where the earnings will double in the next 3 to 4 years. After every quarter, we do evaluate, whether that's still possible going forward, because it's all about looking forward. Just because since investment, we have, the earnings have gone up by 50%, now we only are left with 50. That doesn't make sense, because by that time, even the prices would have reacted. Right? So it's all about looking forward next 3 to 4 years. Can they still double their earnings? At any point we think that's like a remote possibility, we exit. So most common exits for us is because fundamentally the company is not meeting what we are looking for. Valuation, sometimes, as I said, we have a pretty patient sort of range of fair valuation. Whenever they cross that range, and now we think that there is a huge possibility that the earnings are only going to double in 4 years, and then the multiple are most likely going to derate, then that's also a reason that we would. So even if, say, the earnings maybe are meeting at the lower end of our criteria, but the valuations are so expensive, then it's highly likely that the valuations can fall correct by 20, 30, or even 50%. That also a reason for us to exit. And then other common reasons like some events, whether regulatory reason or the management taking the wrong capital allocation decision, or some corporate governance issue, that also there is not much patience that we have with that.
And what is your wait period? So let's say you entered into the thesis, the growth is showing up, but the price is down, and the market is just not recognizing it, and it can happen for years and years. Sometimes market can go into that phase of not giving value to the company. So do you have a wait period after which you say, okay, market is right, we are wrong, maybe?
Right. No, see, one has to evaluate what is the reason. Sometimes what happens is that there is a temporary phase because of which that, okay, now what happened, say, in the last couple of quarters, that the earnings are taking a hit because the freight costs, a lot of raw material costs have gone up, and it does take some couple of quarters for the company to pass on the pricing. Right. So if there is a reason that we understand for the underperformance of earnings, we can wait and watch. But sometimes if we realize, okay, this is probably a permanent structural change which has happened, so now sustainability is a big factor which is under risk, then we don't wait too long. Maybe a couple of quarters, 2-3 quarters is the max we would wait, and we would exit. Because after all, you can't be certain.
Has there ever been a case where market has not recognized an investment you have invested into multiple of years and you held on to it? I'm just trying to gauge your holding power in those scenarios.
Right. See, markets, if the earnings have come through, they have generally recognized. It's mostly like you going wrong in your thesis in terms of fundamental earnings growth is when markets generally penalize you. They generally actually even give you a derated multiple. But I don't remember a circumstance when the earnings have multiplied and then the markets don't care about it.
So there we go to the places where you've made a mistake in your thesis. So maybe you could give us a few examples.
Right. I mean, see, most of the time the thesis has been that the sustainability is the big problem. So for examples like IndoCount, where they are into bed linen, and then I visited their warehouses showroom in New York, and got really good feedback from the designers, from the customers there. But now they were getting into the larger market of bed toppings, fashion design, all of that, which was a bigger market for them. And there, as soon as they got into that, and we thought that there is a huge growth trigger. Valuations were also at 13-14 times kind of a multiple. But then a quarter results, we realized, we were shocked with the kind of margin pressure they had, with the growth pressure they had, even after getting into new segment. So we started digging further into it, then realized that Amazon was completely aggressive, coming into the market. They were taking away market share from their customers. And if the customers are losing market share, then, it puts pressure on the vendor, or the supplier. Right? And that's what happened in the case. So we did evaluate and realized that this is a much longer term structural destruction. And then as soon as margins come under pressure and growth comes under pressure, generally the P multiple gets derated very quickly, and that's what happened. So of course we got out with a loss of whatever 35% or so, but we took that call within the couple of quarters.
So, Samit, we have got most of your selection, portfolio management. One last question from my side, at least, is on the allocation front. How do you decide your initial allocations to the stock? And are you a partial position builder or invest in one go kind of an investor? Similarly, when it is up to selling, do you trim down your positions or do you go move out of positions? Can you give us some color on the allocation? How do you manage that?
Sure. So the allocation decision, so see for us that 16, 17 stocks is a good balance in terms of number of stocks where we are not too diversified, neither are we too concentrated. Because with 16 stocks, actually, if you do right diversification, you take away 95% of the systemic, risk. So that is a good number. So with that, it means that on an average, we need to have an allocation of around 6 to 7%. Right? So our allocation ranges at the lower end 4% and at the higher end 10% at cost. Right? So most often when we build a position, you see the ranking has to be based on wherever we have the highest conviction, with in terms of taking care of the risks and the high returns possible, they will tend to be more towards the 10% and the other way around up to 4%. But most often we will start with 4% allocation for most stocks. And then as we get more and more sort of convinced, because whatever you do at the initial phases of your investment, you will have much lesser knowledge than what you will have maybe 1 year, 2 years down the line. So with that confidence build up, you will slowly keep on building the position. Sometimes that build up happens in a matter of few months, like 3-4 months. Sometimes it may happen over a period of time. And then even within a longer term, so for example, companies which we have held on for a very long period of time, like sometimes PI Industries, Bajaj Finance, APL Apollo, there even within our horizon period, we sometimes have had 4% allocation, sometimes have had 14% allocation or 15% allocation. Because with initial allocation of 10% also, sometimes the market doesn't grow, but the stock grows, your allocation goes up. Right? So you also do some tactical changes during that time, depending on the valuation. So valuation also is a determinant factor in terms of, because if you thought that, it's an attractive company at a valuation of say 30 times, and then the stock say goes up very sharply without earnings going up and the P multiple goes to 40 times, of course it deserves less allocation. So if you thought 10% was the right allocation at 30 times, at 40% it doesn't probably have a 10% right. It will probably have a 7-8% allocation as the right allocation. So that also keeps on changing, but we do it slowly. During exit, most of the time it is at one time. You very rarely have we done slow sort of exits. It will happen within a matter of a month or so.
So only selling which is partial is where you are trimming your position for the reasons you mentioned. Otherwise, if you've decided to move out of the position, you will move out of in one go. It's not about profit booking, partial profit booking, or any such thing. So understood. Great. And we unfortunately, the time is always a constraint, but I would want to have one podcast with you where we only talk spirituality, because I heard one of your podcasts where you talk about that, and it's an area of interest for mine, but I wanted this one to be more investing centric. In one of them, we'll not talk about investing, we'll move solely into the spiritual side of things. But one point I do want to cover is that I have seen that in your life, serendipity has pretty much played the role at all the key juncture, be it you going to US, be it your losses and your entry point into the market being 1999, be it coming to India and not finding IBD, because I'm guessing if IBD was there in India, you probably would not have changed your style, and serendipity has pretty much played. How do you bring that aspect of your life and learnings of serendipity working for you into your investment style, if at all you do, or you don't try to mix the two, and just give us a color on that if possible.
Yeah, I mean, see, what I have learned in life is that you are going through experiences. There is no point of me sort of stamping an event, whether it's a good event for me or a bad event for me. Just because I made a lot of money this year doesn't mean it's a good. It may not lead into happiness, because after my end goal has to be, happiness, right? So I, of course, don't judge an event. Even if something bad happens to me, I don't know what the repercussions of that is going forward, right? My job is only to, take action, right? Events will keep on happening. I need to believe in the universe, saying that universe is what will take care of the results for me, and which are going to be good, because I am not a judge of whether an event is good for me. I am not at that level to know what is happening today is good for me, because you can have a great, you will probably, you propose to someone, and she accepts the proposal, and she becomes your wife, but then you can go through a really bad divorce 5 years down the line. So something which you thought was a great event may turn out to be one of the worst decisions of your life. So why judge an event? Let life unfold in front of you. You keep on taking decisions based on what you think is right. Follow your passion and let the results come to you. And that's how I have done. Whether in terms of changing my job, I thought that was the right decision for me. Starting SageOne, that was the right decision for me. Going to the US was, obviously, I had no option anyway. So, I just took the best option which was available to me. But you just need to keep on decisions without getting affected. Even if things are happening great, I think you should not get too excited. If things are happening bad, never know what is going to happen maybe a few years down the line. So take it as it is. If the universe has delivered you something, accept it with full heart. Don't create friction by saying that, no, I wanted this and I wanted that. Keep the flow clear, open to it, and generally what is right for you will come to you.
Yeah, just to ask one last point on that, sorry, Nooresh, just one small point is that even though you don't judge the events, but you do learn from your decisions which you have made in past, even though the decisions are not made with the best of information, people tend to go back and reflect on the decisions they made, and they try to come up with learnings from those decisions. That is one exercise which I've always found to be helpful but futile also, because we judge the decisions as if we had all the information while making those decisions, which actually comes to us much later, and then we reflect on those decisions. So are you saying that that's a futile exercise to do? I mean, do you go back and reflect your decisions and you say, why would I took that decision now?
Right. See, when you live life, after all, you collect a lot of data, memory, and based on that, your decision making can change, because through experience you learn what is right and what is wrong decision. Because you need to take a decision with full intellect and with full, compassion for others. If you take the decision, and then with intellect means that you have to analyze what has happened in the past. Based on that, you need to take a decision. But just because you have taken wrong decision, you don't need to repent and keep on thinking back. Okay, that happened. Now going forward, you just need to incorporate that learning and keep the decision. But again, you may again go wrong. That's also fine. You keep open, to that kind of a possibility, and not keep on fearing that have I taken a wrong decision? Because that's like you are living a sort of a tied life. You need to live a free life, with acceptance of what's going to come, without any kind of a fear. Sorry, Nooresh, you were saying something.
No. So we are coming to an end. So what we do, I'll suggest a segment where me and Puneet ask you random questions, but you have to answer in a line. And so I think I'll let Puneet start with a question, and a random question out of nowhere, and you need to give it in a line. No more explanation, just a conclusion.
And we haven't planned this, okay? So it's going to be random for us also. Okay, okay. The best book you have ever read and you're learning from that?
Ashtavakra Gita. Learning is the same thing that we spoke about.
You said about earnings growth above accountability and efficiency, or the other way around. You're okay to let go accountability if earnings growth is there.
Earnings growth is the main thing, but there has to be some accountability.
So it's basically earnings growth above accountability.
Okay, many times investors leave, many companies based on very minor forensic issues. How serious you are on the forensic part of balance sheets or financial statements?
No, if you find some fraud in terms of numbers or how they represent, if there's wrong data to evaluate, that's a complete no-no. Just stay away from it.
So, BAP investing or not? Buy at any price or not?
No, no, no. Within that reasonable range, but that range has to be a little flexible. Not, don't need to be that stringent about that one number. Okay, if it's above this, I'm not going to buy it.
If you weren't an investor, what would you have been?
I would have been probably a monk. I think nothing else makes sense to me.
Perfect. Absolutely pleasure, Samit. It was great talking to you. Learned a lot. I'm going to, go through the podcast, make my notes. But it was brilliant talking to you. We'll definitely do one more podcast where we'll not talk investing. We will only talk spirituality. But thank you for giving us your time.
Thank you, Samit. It was great interacting.
No, it's absolutely my pleasure.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.